Oil, once again, the big driver of the action, gaining 5% on continued threats to tankers in the Strait of Hormuz, despite a release of reserves from IEA countries. Shares of Caesars making a big move late in the regular trading session on a report that Tillman Fertitta is in talks to buy the company for $7 billion. That's about $34 a share, higher than a recent bid from Carl Icahn.
Well, the rise in oil prices has investors cutting their outlook for Fed rate cuts this year, predicting higher inflation and the potential for slower growth. As a result, the markets are now pricing in just about 30 basis points of cuts for the year. The drop in expectations coming as bond yields rise across the globe as well. Joining us now to discuss the state of the bond and credit markets is Priya Misra. She is JPMorgan portfolio manager focused on fixed income. But it's good to see you.
Thanks for having me.
So, yes, yields in the U.S. and everywhere kind of like migrated up to the top end of this range. We're pricing in a little bit less from the Fed. Is it an inflationary story there? Is it something else? And where does it head from here?
So I think the market, the rates market, is viewing this simply as an inflation shock globally. So that's why, you talked about global rates have risen. In fact, the U.S. has outperformed. I would argue a geopolitical risk-driven rise in oil prices is a stagflationary shock. So I think the market's focused on the inflation part. There's the growth aspect as well. This is a tax on the consumer. The consumer, which has been actually doing okay, has been drawing down savings. And so I'm thinking there's not a lot of buffer here. If oil prices stay high for longer, I think it's going to be a drag on growth. So I would argue the market has been too myopically just looking at the inflation side. I don't think any central bank, particularly the Fed with a dual mandate, is likely to not cut rates. We still think the Fed's likely to cut rates later this year because we're in a low hire, low fire labor market. We think headline inflation will likely rise. But, you look at the details of inflation, the underlying trends are actually slowing. And, I don't see that second order effect. It feels so different from 2022. But I think the market has some PTSD from what happened in 2022. The fact that it was an energy price increase that sped over. So that's what the market's pricing in. Mm-hmm. I actually think this is an opportunity. There's value being created in bonds. I think owning some short duration treasuries is actually a hedge against growth slowing down, credit fears. There's a lot of things where treasuries will give you liquidity and they'll sort of give you that hedge property as well.
Where are those opportunities in bonds? I mean, just yesterday was a historic day in terms of corporate investment grade bond issuance. Is that where you want to be these days? And does the issuance of so much data center related paper, is that going to cause, prices to go down, excuse me, basically?
So that's a great point. I'm really glad you brought up all the supply because, you hear of credit fears and are we at the end of the credit cycle? Then we have this lots of supply yesterday. The new issue concessions were not that high. And look at the post-pricing performance was actually excellent. We're seeing inflows come into investment grade bond funds. We're seeing inflows. I think people are looking at all-in yields, 5.5%, 6% if you can go into high yield with lower sort of volatility. That's why we're seeing the inflows. When you talk about the data center, I would say AI-related supply, if it's the hyperscalers, we actually like those business models. We like the fact that they don't have a lot of debt. So, software aside, that's why I think the market's saying the AI winners versus losers. I think you have to do a lot of work there. Leverage is much higher. But the hyperscalers don't have that much debt. So we've liked that sector. There's obviously at the right price, making sure that we're not over-invested in one particular sector. But, I think it's very healthy for the market that it's open, that when a good quality company comes in and issues debt, there's plenty of demand. These books were highly oversubscribed. I think that's very healthy for the credit market. There's dispersion. So you have to be very careful. You know the borrower. You can read the covenants. But I think overall that demand is there for credit.
I was going to say, when it comes to corporate supply, that is demand, too. When the deals get done and they don't have to do it at very onerous yields, that's demand. Just in terms of the Fed, now the market is still leaning toward there'll be room for a cut, maybe a little bit more. But yet we're talking about looking at today's CPI and translating into PCE terms. It's still going to be elevated. It still all seems to move in the direction of a very kind of wait-and-see Fed.
And I think we have a Fed meeting coming up. Yeah. I think it's going to be a wait-and-see Fed meeting. There's a lot of uncertainty. The Fed has cut a reasonable amount the last 2 years, so they have the luxury to wait. They can see how the data plays out. I think there is a very clear division, though, at the Fed. The two sides of the mandate are in tension. There are those people at the Fed that are nervous about the employment side. There are others worried about inflation. Now we're dealing with a stagflationary shock. So whatever that division was just got stronger. Mm-hmm. So I think they're wait and see. What I'll be watching will be that reaction function. So I think historically, central banks, the Fed, looks through oil shocks. Do we get that sense that they're going to do that again? Are they going to look at longer-term inflation expectations? Those have been remarkably well behaved.
Sure.
I think the market's saying this is a short-term shock. This is just going to be energy. The economy is otherwise healthy. I think if you start to question any of these assumptions, how does the Fed respond to it? That's what I'll be watching, not looking for anything next week. But I think the dot plot, we're also going to get that famous dot plot. Yeah. I think that's going to signal further rate cuts because I think the majority of the committee still thinks we're slightly restrictive. So that's why the market has these rate cuts. Maybe we push out the cuts from 26 to 27. But the market's forward-looking. As long as the Fed says we're in a path towards cutting rates, I think that's going to help cap how high, the 10-year can be.
Sure.